Hey everyone, welcome back to Corporate Decoder, the place where we dig into company filings and try to find out if this bank is printing money or just burning it. Alright, so we're diving into RBB Bancorp's latest quarterly report for the period ending the 30th of September 2025. This company is a bank holding company and their main gig is lending money and taking deposits, basically a bank but with a fancy holding company structure. They serve a lot of Asian American communities across California, Nevada, Illinois, New Jersey, and Hawaii. Let's cut to the chase and see how they're doing financially, because that is where the real story is. First up, the balance sheet. This is like a snapshot of what the company owns and what it owes. At the end of September 2025, RBB Bancorp had total assets around $4.2 billion. That is up from about $4 billion at the end of 2024. A good chunk of that increase is in their loans held for investment, which grew to over $3.3 billion. On the flip side, their cash and equivalents dropped a bit to about $235 million. They're putting more money to work in loans. They also have a hefty $3.4 billion in total deposits, well over $500 million in non-interest-bearing demand deposits, which is great for them because they pay no interest on that money. Now let's look at the income statement. This tells us how much money they made and what they spent over a period. For the third quarter of 2025, RBB Bancorp reported a net income of about $10.1 million. That is up from $9.3 million in the previous quarter and a nice jump from $7 million in the same quarter last year. The revenue from interest on loans is their bread and butter, bringing in around $50 million for the quarter. But here is something interesting. The second quarter of 2025 had a big boost in other income because they got a refund for an employee retention credit of about $5.2 million. That is not in the third quarter figures, so comparing them directly isn't totally apples to apples. Scroll consolidated statements of cash flow C-Center. The cash flow statement shows how money moved in and out of the company from operations, investing, and financing activities. For the first 9 months of 2025, the company generated about $31.5 million from operations. Investing activities used up a lot more cash though, at over $244 million, largely due to purchasing more securities and making more loans. Most of their cash actually came from financing activities, that is where they're borrowing money and taking in deposits this quarter. They brought in over $190 million. Let's get into the nitty-gritty of their loans. Their loan portfolio is pretty concentrated in commercial real estate and single-family residential mortgages, with close to 50% of their loans being single-family residential mortgages at over $1.6 billion. Commercial real estate loans are the next biggest chunk at over $1.2 billion. They also have a pretty decent construction and land development loan portfolio, a bit over $159 million. What's super important here is their allowance for loan losses. As of the 30th of September 2025, it stands at over $44 million. This is the buffer they have for potential loan defaults. It is down a bit from the previous quarter, mainly because of net charge-offs, which are loans they write off as uncollectible. Looking at the table for the allowance for loan losses, you can see the changes. For the 3 months ending the 30th of September 2025, the charge-offs were pretty high, totaling over $7 million. Most of that was from one commercial construction loan connection. The provision for credit losses, which is money set aside for potential future losses, was only $750,000 in that third quarter, which is quite low compared to the charge-offs. Their total loans held for investment are over $3.3 billion. The ratio of the allowance for loan losses to total loans is about 1.36%. This is down a bit from last year, which could be good if loan quality is truly improving, or it could mean they're less protected if things go south. Now let's talk about non-accrual loans. These are loans where the borrower isn't paying. As of the 30th of September 2025, they had about $45 million in non-accrual loans. That is a significant drop from over $81 million at the end of last year. This is a positive sign. Their construction and land development loans and commercial real estate loans are the biggest chunk of these non-accrual loans at over $28 million and $8.5 million respectively. Let's peek at their debt. They have about $120 million in long-term debt, mainly in subordinated notes. They can redeem these notes starting in April 2026. They also have subordinated debentures related to trust-preferred securities totaling around $15.3 million. They are compliant with all their debt covenants, which is good to see. They also use borrowings from the Federal Home Loan Bank. At the end of September 2025, they had about $130 million in advances compared to $200 million at the end of 2024. These are short-term borrowings, which is normal for banks to manage their cash flow. RBB Bancorp is pretty well capitalized, and they seem to have enough liquidity to meet their obligations. Their total shareholders' equity is over $514 million. They also have plenty of access to funding through FHLB advances and other borrowing lines if needed. The bank itself is also a good source of funds for the holding company. Now, no company report is complete without a dose of reality in the risk factors section. RBB Bancorp lists a bunch of potential dangers. Things like economic downturns, interest rate changes, competition from bigger banks, and unexpected events like natural disasters or public health crises. They also mention the risk of cybersecurity threats and potential goodwill impairment. They are careful to say these risks could materially affect their business. They also highlight their critical accounting policies. The allowance for credit losses is a big one, and they ran a sensitivity analysis. If unemployment goes up by just 1%, they could see their allowance increase by almost $1 million. They also stress test their portfolio under moderate and major economic stress scenarios, and they feel they would remain well capitalized. Let's talk market risk. They're mainly concerned about interest rate risk. This means changes in interest rates can affect their profits. At the end of September 2025, they were a bit liability sensitive, meaning if rates drop, their net interest income could take a hit. They modeled this using net interest income at risk and economic value of equity analysis. The numbers show their position is within their policy limits, but to raise always that risk. Here is some juicy info. RBB Bancorp announced a plan to buy back up to $18 million worth of their own stock, and they've already repurchased quite a bit this year. This can sometimes signal confidence from management, or it can be a way to boost earnings per share. They bought back over 659,000 shares in the third quarter alone. So what is the verdict on RBB Bancorp? On the surface, they look pretty solid. Their net income is growing year over year, and they've seen a good drop in non-performing loans, which is a big win. Their loan and deposit growth is steady. However, the increased reliance on wholesale deposits and FHLB borrowings, especially after their fixed rate advances matured, might be something to watch. Also, that slight reduction in their allowance for loan losses as a percentage of loans HFI when net charge. Offs were pretty high this quarter warrants a closer look. It seems they are betting on continued good loan quality. The fact that their stock repurchasing program is active suggests management's confidence and a desire to return value to shareholders. RBB Bancorp is navigating the current financial landscape with decent results, but like any bank, it is exposed to interest rate and credit risks. Staying on top of those non-accrual loans and managing those loan loss provisions will be key. Alright, that is our deep dive into RBB Bancorp's latest filing. What do you think about their strategy and these financials? Let me know in the comments below. If you found this breakdown useful, please smash that like button and subscribe for more insights from the world of corporate finance. And hey, if you want to connect with other finance enthusiasts or ask questions, join our Discord community, link down in the description. Thanks for watching, and we'll see you in the next video.